So there's been a lot of news about China that's been impacting global markets. We've seen a plunging stock market. China announced that it's moving to a more flexible and market-oriented exchange rate, and China's central bank recently announced that it's cutting interest rates. While growth has clearly slowed, we don't think China's headed for a hard landing. A lot of the long-term drivers of China's growth, things like urbanization, still have years to run. China is allowing an adjustment in the property sector and in manufacturing that's reducing excess capacity and reduces the risk of a larger and more disorderly adjustment later. And the central bank's move highlights that China still has a lot of tools in its policy toolbox to support growth going forward. What China needs to do is strike the balance between growth and adjustment. Growth that's driven by see-through apartment buildings, by more steel plants, and more debt won't be sustainable. We believe what was driving China's decision to change its exchange rate regime was both its long-term reform agenda and short-term cyclical factors. China wants to become part of the IMF's SDR basket, and its campaign to join the SDR has been very important in driving support for China's financial reforms. We don't think there's any coincidence that China's move on exchange rate came only a week after the IMF released a report assessing China's eligibility. Secondly, there were short-term cyclical considerations. Growth has slowed, inflation is low, there's deflation in many sectors in China, and in the face of this, monetary policy was actually getting tighter. Credit growth was coming down, interest rates adjusted for inflation were staying very high, and most importantly, given the strength of the US dollar, China's currency was appreciating against most other currencies in the world. Only a few weeks after China changed its exchange rate regime, there's a lot more we don't know than what we do know about how China's going to conduct exchange rate policy going forward. What's very clear is this is still going to be a heavily managed exchange rate regime. While we think China wants a weaker exchange rate, we don't think China wants a significantly weaker exchange rate. China still wants to limit capital outflows and still wants to promote its effort to join the SDR. Also, we don't think an overvalued exchange rate is a problem for China's competitiveness. We think a lot of the recent decline in China's export growth has much more to do with weak global demand than an overvalued currency. China is the biggest trading partner for most Asian economies. It's a competitor in a lot of export markets around the world, and also China's a major commodity importer. So any changes in China's growth or its exchange rate policy is going to have a big impact in the world, particularly on Asia. We think the currencies that are going to be most affected by China's move are going to be the Korean won, the Taiwan dollar, and the Malaysian ringgit. We've seen some weakness in Asian markets, but we don't think this is the beginning of another Asian financial crisis. Asia is a lot stronger today than it was in 1997. Foreign exchange reserves are up, external debt is down, Asian governments and companies are financing a lot more of their debt in local currency. Banks are better capitalized. A lot of trade deficits back then have declined or moved to trade surpluses, and most importantly, exchange rates have become much more flexible. They've moved a lot, and when we look in Asia, we don't see the kind of overvalued currencies that we saw 20 years ago.